This lesson focuses on the supply-side relationship of your company. In the bio-based economy, the supply side is, in a sense, what it is all about. After all, bio-based markets and supply chains are, by definition, characterized by the feedstock they use, biomass. Biomass refers to regrowable matter, mostly of vegetable origin. The range of biomass feedstock is very wide. Biomass may be grown on purpose for the bio-based application, such as maize and sugarcane for bioethanol, sugar beets for polylactic acid, rapeseed for biodiesel, or wood for construction. In that case, the bio-based application is the core product. In other cases, we may use side products or even biomass labeled as waste. You may think of straw, hemp chives, grey starch from potato processors, or black liquor from paper mills, or manure, sewage sludge, or organic waste. It is good to realize that bio-based resources are not the same as fossil resources. They provide a supply chain that differs from fossil supply chains in many ways. And these differences profoundly impact procurement policy, logistics, and business strategy and risks in general. I mention some of the differences. Biomass is grown in growing seasons. Prices, volumes, and even quality may rise and fall with the seasons. For instance, sugar beets are not available at all outside the harvest period of some 5 months. The yield of red colorant from madder roots is dependent on the weather conditions. It is not OPEC or Saudi Arabia that determine price dynamics, but the traditional CoEBBE phenomenon known from the agricultural markets. Also the local weather conditions and eventual worldwide crop failures. Later in this lesson, I will provide you with an example from Mexico. Production of biomass is geographically quite dispersed. If we want to reach the level of bulkiness of fossil supply chains, much logistic and contractual accumulation needs to be done. For instance, if you want to use wood for energy, it must be collected from a wide and ever-changing area, whereas oil is collected from a few fixed sources through pipelines. Much of the biomass, especially the residuals, is of relatively low value compared with its weight or volume, which makes sourcing a local enterprise and logistics all the more challenging. For instance, the Shell subsidiary Iogen was to build a straw-based bioethanol plant in Germany on a scale which meant they had to source their straw from all over Germany. Apart from the fact that straw is hardly a side product and it is logistically unsound to drive such distances with straw because of its low volume density, it would have had a profound price effect. The plan never worked out. Bio-based business is essentially a feedstock game because of the extent to which the feedstock determines your business result. Imagine you are the procurement officer of a company that intends to switch to using biomass. One of the main models that you learned in your procurement training was the portfolio of Kraljic. The model describes the type of procurement strategy to be pursued for a single resource based on an estimate of the importance of the resource and the riskiness of the resource. Importance, for instance, in terms of the percentage of production cost price involved. Riskiness, for instance, in terms of the ease of switching to other suppliers. As a result, the company must choose between 4 options: strategic partnering, hard buying, risk reduction, or routine buying. You must realize that biomass resources make more expensive end products, so they drive up production cost prices. They are more challenging in terms of security and quality of supply. They are a main driver for the end product's value proposition, as for instance in terms of sustainability. And they mostly comprise the main part of the financial business risk. As a result, feedstock price levels, the dynamics and the availability of volume are to such an extent determining both your business case and your business risk that the portfolio model of Kraljic would prescribe strategic partnering as a logical outcome. Therefore, it is unsurprising that investors often require a company to secure its feedstock contracts well before any investment is considered. Neither is it surprising that large biochemical companies such as Novamont pursue the strategic partnering route. Novamont in Italy is one of the most successful innovators in the bio-based chemicals world, and it has invested in arable farming. It is said that more chemical companies are considering this scenario to avoid price and volume risks. Another effect of this scenario is that the company obtains access to knowledge about product varieties, productivity, sustainability, etc., which will help them when trading on the market. This scenario applies to residuals also, and it may be wise to either contract different volumes or cooperate with a sourcing or trading organization. Contracting entails volume obligations, which may be difficult for a startup company. Novamont established their own farms to reduce risks. For more examples and theory on partnering, I refer you to the next chapter, which is completely devoted to partner strategies. Feedstock owners hold the key, and therefore have an advantage, even a certain responsibility, for investing in the bio-based innovations and transition. In general, the importance of the biomass feedstock to the business case and the value proposition is such that we may justifiably claim that bio-based business is a feedstock game. There are three main types of biomass in terms of strategic consequences: commodities, private produce, and residuals. Commodities rely on extensive and homogeneous markets with many suppliers and many buyers. Examples include white sugar, corn, rapeseed, palm oil, wood pellets, and half-products such as bioethanol. It is hardly imaginable that any single bio-based producer can influence the prices and volumes in these markets. Qualities are standardized and the produce is traded over exchanges such as the Chicago Board of Trade, Euronext, or several online trading platforms. These exchanges offer transparent spot pricing and several risk hedging instruments. Risks can be hedged by using futures contracts. Things are different when feedstock and processing are owned by a single company. Let us say the processor possesses its private stock of produce. When the downstream chain has been developed by a farmers' cooperative, the feedstock and processing are owned by a single company. One example is the bioethanol branch Crop Energies of the German sugar beet cooperative Südzucker. Feedstock and processing are also of the same owner when the processor has invested in private feedstock production like Novamont did to secure part of its access to volume, quality and price. When you plan to use residuals, but you don't own them and must buy them on the market, there is almost always contracting involved instead of spot trading. The producer who sees no value in his rest streams wants to be routinely serviced at low costs and risk. The buyer wants to secure access if the source is very specific and requires specific investments, for instance in logistics. Even if markets appear to start out as a commodity such as manure or wood chippings from nature management, the value of the product is so low that logistics are expensive and the market is practically regionally restricted. A scaling up processor will increasingly step out of the commodity scenario into a monopsonist scenario for its surrounding region, profoundly impacting the price level. Companies that are planning to use residuals but do not include this price effect may encounter severe problems. For instance, an investor in an innovative process for wood-based bioethanol in the Netherlands had built his business case on the assumption that all waste wood and cuttings from a wide region, at least 20 municipalities, could be procured at the same waste premium that was usual before the development. This was irrational, and the plan never worked out. Another company planning to build a large-scale manure dryer did better. The company was well aware that to reach their optimal scale, they had to absorb half the manure surplus in the wide surroundings. As a result, they built the business case on an estimated price raise, which was a very sound idea. Nevertheless, this plan did not work out either, but that was for other reasons. A special feature of bio-based feedstock is its seasonality. For a company experienced in the procurement of fossil feedstock, the bio-based world may prove rather strange. Often I have heard chemists mention that it was the responsibility of me and my kind, being economists, to organize stable and cheap feedstock. However, bio-based markets do not function that way. Prices are bound to variations in production, and these variations are influenced by climate variations, droughts, but also by price variations in the past. The reaction of farmers to price changes takes at least one growing season, the famous CoEBBE phenomenon. For instance, the notorious tortilla crisis in 2007. Due to international market price dynamics, reportedly caused by the switch of food corn to bioethanol corn in the United States, prices for food corn in Mexico soared in 2007. This rise was followed by investments in local production and a record harvest in traditional corn production in Mexico. A blessing for the local farmers and a stabilizing factor for maize prices in the future, both for food and ethanol markets. For farmers and food supply chains, such price risks are not unfamiliar. They introduced instruments for price risk hedging along with the commodity exchanges. Every agricultural commodity exchange has, in addition to the spot market trade, term trade in the form of futures contracts. Farmers and food processors take positions on these future markets. As a result, farmers can secure their revenues well ahead of the harvest, and procurers can secure their profits well ahead of the production itself. It sounds a relief to have such risk-reducing instruments, yet it comes at a cost, especially in terms of working capital. A startup biodiesel producer once explained to me what his daily business was. It was not to manage the plant. There were hardly any risks involved that could not be handled by the skilled operators. His business was to buy the rapeseed at the right price, which completely determined his business case. Biodiesel prices were low, but he could make a profit by reselling to the food market. As a result, he sat all day behind his computer to trade on the Paris exchange. This game, unexpectedly for me, impacted his balance sheet. All produce bought in futures trade sat on his balance sheet. And to trade futures contracts, a company is obliged to display 1 million euros liquidity on the balance sheet. Both the future stock and the 1 million cash had to be financed. You may calculate your interest burden. For more details on the finance of bio-based business, I refer to Chapter 6, Funding. Another particularity of bio-based chains is the quality of the feedstock. When dealing with side or waste streams, the quality and availability may prove a problem. Industrial side streams are mostly well-defined and constant, but municipality waste, also agricultural residuals, may prove less homogeneous both in quality and in time. A greenhouse company in the Netherlands planned to make a product out of the waste stems that remained after the harvest. They found an interesting technology to process their stems into partly bio-based, partly ceramic plates for construction. They invested in a production plant, but instead of processing their stems, they began production with wood fibers that are homogeneous and available year-round. There is a special name for bio-based chemicals that are indistinguishable from fossil ones, such as bioethene. These chemicals are called drop-in. These are physically exact substitutes for existing fossil-based chemicals. Bioethene is exactly the same as fossil ethene, but it is made from a sugar-based ethanol instead of ethene from cracking fossil oil or gas. Such bio-based drop-ins are generally more expensive and available in lower volumes than their fossil nephews, therefore they must distinguish on sustainability value. Until now, we have been considering the procurement perspective of a bio-based producer, which is in a downstream position. However, it was previously mentioned that those who hold the feedstock have a certain responsibility to invest in bio-based innovations, and many do. Let us consider therefore the other perspective. I have biomass and I consider selling it to bio-based production chains, either because I am developing the production myself or I have been contacted by someone interested in buying it. As long as these supply chains are connected through commodity markets, it is hardly an issue. You sell, but you do not know beforehand to whom. Commodity markets require a certain size, degree of organization and some logistical formula under them. The markets offer security, but they include an important disadvantage. You cannot distinguish yourself regarding quality or sustainability. As soon as you connect your own resources to a single application, for instance, since you are developing it yourself, or you have a launching customer, it becomes riskier but also more rewarding. It is always wise to have an alternative at hand, and if specific investments are necessary for this single application, for instance intermediate storage, it is wise to require contracts. As soon as you have a relatively low volume to trade, or the quality differs over time or over different volumes, there is room for intermediary services such as traders and logistics service providers. Traders or wholesalers may specialize, for instance, in collecting and reselling biomass waste and have functions such as the following: sorting out different qualities, accumulating volumes of different sources into one volume, allocating this accumulated volume over different interested customers, and combining the single residual with other residuals that may be interesting for the clients. Using regrowable feedstock, bio-based applications are more sustainable than applications of fossil origin, be they from oil, coal, gas, sand or phosphate rock. The CO2 footprint has a head start since biomass catches in CO2 when growing. If further downstream the CO2 is not offset by additional energy inputs from fossil sources, which may sometimes be the case, the entire supply chain emission is more favorable than that from fossil chains. There are, however, more concerns than greenhouse gas emissions. These concerns mostly concern the sustainability of primary production, the production of the feedstock itself. During this production, greenhouse gases such as laughing gas may be emitted. Also, does the agricultural production maintain soil productivity and fertility? Does agricultural production require the destruction of nature or natural habitats? Other concerns have to do with usage of water, the spread of herbicides and pesticides, and overutilization of fertilizer. These concerns are all held in the end markets. To secure the sustainability of production of these end customers in food chains, many labels are in play. For agricultural production, general labels such as Europe GAP or Global GAP are enforced by the buyers. Large food retailers hold and enforce private regulations. For sustainable forestry, we have the FSC labels, and other labels are imposed by bioenergy companies. Large buyers may require that you hand in an LCA, a life cycle assessment. Yet the larger markets, such as for biodiesel or bioethanol, depend on commodities. In such markets, labels are difficult if not impossible to implement, and the concerns remain. To conclude this lesson, I repeat that biomass feedstock is essentially different from fossil feedstock, for instance, because of the seasonal influence. Biomass feedstock is thus important to your business case that strategic partnering is often advisable. There are different market formats, and there are some caveats as to local market price effects for residuals and working capital requirements for commodities. Again, we may say that bio-based business is a feedstock game.